Current Asset Management, Chapter 7, Part 3. Credit Standards. They determine the nature of credit risk based on prior records of payment and financial stability, current net worth, and other related factors. We refer to the 5 C's of credit. Character, which is usually determined from a credit report. Capital, are they producing enough income each month or each year to meet their obligations? Capacity, are their cash flow needs meeting what is necessary? Capital was, do they have enough cash on hand? Is their balance sheet strong to where they could support any kind of information as far as any kind of different lending or short-term needs they might have? Capacity is their cash flow. Is it producing enough income that they can meet their obligations? Conditions is referred to the terms. Is it going to be a 3-month line of credit? Is it going to be a 12-month note? Is it going to be a 30-day agreement between the company and the creditor? And collateral, if you can't meet your obligations, what are you going to say that I can have to help meet your obligations or to liquidate that I can use to meet the obligations? So those are the 5 C's of credit that most banks and creditors will always look at. Another information as far as credit standards are concerned, meaning that character, is Dun & Bradstreet Information Services. Produces business information analysis tools, publishes reference books, provides a computer access to information, and assigns data universal number systems, which is a unique 9-digit code to each business in its information base. Here's an example report of a Dun & Bradstreet report that would be printed off if you generated one to show how well the company is doing based on, are they trustworthy for you to give them any kind of lines of credit or short-term notes. Terms of trade. Stated term of credit extension has a strong impact on the eventual size of accounts receivable balance and creates a need for firms to consider the use of cash discounts. Collection policy. A number of quantitative measures are applied to assess credit policy. Average collection period. An increase would indicate poor credit administration. Ratio of bad debts to credit sales. An increasing ratio may indicate too many weak accounts or an aggressive market expansion policy. And aging of accounts receivables, all determined from the average collection period, which is accounts receivable over average daily credit sales. Here's an example of an actual credit decision. It brings together various elements of accounts receivable management. Accounts receivable is sales over turnover, which would be 1667. An average investment of 1667 is fetching a post-tax profit of 480, which is approximately about 28.8%. Inventory management has 3 basic categories: raw materials, work in progress, and finished goods. Amount of inventory is affected by sales, production, and economic conditions. As inventory is the least liquid of current assets, it should provide the highest yield. You also have to consider level versus seasonal production. Level production allows maximum efficiency in manpower and machinery usage and may result in high inventory buildup, particularly in seasonal business. Seasonal production eliminates inventory buildup problems, may result in unused capacity during slack periods, and may result in overtime wages and inefficiencies arising of overused equipment. Inventory policy and inflation and deflation. Inventory position can be protected in an environment of price instability by taking moderate inventory positions, hedging with a future contract to sell at a stipulated price some months from now, or rapid price movements in inventory may have an impact on the reported income of the firm. The inventory decision model also includes carrying costs, interest on funds tied up in inventory, cost of warehouse space, insurance premiums and material handling expenses, implicit costs associated with the risk of obsolescence and perishability, and then ordering costs, which is the cost of ordering and cost of processing inventory in stock. Determining the optimum inventory level is always interesting game that many manufacturers and retailers have to play, and that's the cost of ordering and receiving inventory and your total costs and meeting that balance for securing costs and ordering costs, as you can see from this graph. Safety stocks and stock outs. Stock out occurs when a firm is out of a specific inventory item and unable to sell or deliver the product. Can also occur if they missed a forecast as far as sales forecasting was concerned, and they don't have it in stock in order for them to sell it. Safety stock reduces the risk of losing sales, increases cost of inventory though due to a rise in carrying costs. This cost should be offset by eliminating lost profits due to stockouts and increased profits from unexpected orders. Just-in-time inventory management. The basic requirements for just-in-time is quality production that continually satisfies customer requirements, close ties between suppliers, manufacturers, and customers, and minimization of the level of inventory, cost savings from lower inventory, and an on-average just-in-time has reduced inventory to sales ratios by 10% over the last decade. End chapter 7.